Welcome to Oregon Cash Flow Pro. I'm James Barber, and I'm here to help you maximize your cash flow. And one of the things that we like to do to maximize our cash flow is to consider the details when we're trying to decide on what to make for an investment. High yield dividend ETFs have gotten very popular lately, and I cover them quite a bit on my channel because I have a high yield dividend ETF portfolio used to generate some income. But there's a lot of discussion out there about people that don't like them and what they think you should be in instead and why you should be in them. What I want to cover today is there validity to that? And we're going to look at one specific example. There's all kinds of examples that we can use out there, but ultimately, how you end up using or choosing whether or not to use a high yield dividend ETF or go directly to the underlying to invest is going to depend on how you decide to answer some of these questions that we're going to tackle here. But we're straight up going to look at these numbers. We're going to do QDTE versus NDX. QDTE sells 0 days till expiration, covered calls, against the underlying, which is the NDX. So we're going to cover what does the total return look like over a specific period of time? What is the tax impact if you were to choose one or the other? And what is possible use cases where you might choose one or the other outside of whether you're just considering total potential return or the tax impact? So let's hop into this. But remember, if you have any questions about this stuff, definitely put them in the comment section below, because I think it's important to have a discussion. Viewers can look at that discussion and use it to help inform to make better decisions. I'm not recommending you do one or the other because this video is not giving you specific financial advice. I do give financial advice on this channel, but it's not specific to you. We're talking to a general audience. So I try to frame this in a way that will help you utilize the information that I present so that you can make smart decisions. So you're not going to hear me make a disclaimer that says, this is for entertainment purposes only, not financial advice. No, it's definitely financial advice, but it's not specific financial advice to you. You've got to recognize that. It's up to you to analyze what you see out here and figure out how it applies to your situation. Now, if you want to talk specific financial advice, you can schedule a free consultation with me. The link is right over there. I meet with people for all kinds of reasons. I help people maximize their cash flow. I design the absolute best life insurance policies for high cash value purposes. I can also sell term insurance, but I'm not licensed to operate in the stock market and run your portfolio or tell you how to invest. So when we talk stock market, when we talk trades, we're just doing education. I'm sharing what I've learned, what I know, things that I think might help you do better and to help you optimize. So with that said, let's hop into this. We got a bit to cover. Let's start with earlier this year, January 29th, to be exact. I started a challenge using QDTE where we used $10,000. We took a loan from one of my life insurance policies. We could borrow at 5% interest, and we purchased 251 shares of QDTE. The idea behind this is we're going to utilize the dividends that this is going to kick out, and this kicks out a dividend every single week. And we're going to use those dividends to pay back the loan. So this was a specific use case, and we framed it as a challenge because we didn't know how this was going to play out. These type of indexes are relatively new. This one had been out for a year, and at the time, it had actually outperformed the underlying NDX by about 3%. So when we hopped into it, we figured the dividend payout was approximately 30% or so, and we should be able to make enough off of the dividends to pay back the loan in around 3 years, at which point we still hold these underlying shares and they'll continue to kick off dividends. So we're buying a cash flowing asset that's going to continue to cash flow after we've paid off our loan. This is very similar to owning a rental property. I say this all the time. High yield dividend ETFs, I treat them like I'm buying a rental property. If I were to buy a rental property, we're going to use some cash. We're going to buy the property and we may get leverage and buy more house than what we have in actual cash, but we're going to use the rents We're renting out that property to pay the loan back, to pay the mortgage, and our original investment. And when everything's paid back, it's going to continue to kick off rents well into retirement. Like, that's the main goal of a rental property. So we're kind of looking at this the same way. Now, some people like to say these are like annuities. I don't liken them to annuities because annuities have guarantees. Annuities, you know exactly what your payout is going to be. In here, we don't know what it's going to be. It's going to go up and it's going to go down. The value of the underlying is going to go up and it's going to go down. The value of our shares is going to go up and it's going to go down. So we don't actually know a lot of things in here. So there's not the guarantees that you get from an annuity. So I liken this more to rental property. It's also akin to buying a business. And the business is selling covered calls against the underlying in here. Now, one of the things that attracted me to this particular fund is the underlying is a major index. The NDX, top 100 companies, top 100 tech companies in the US, and it's not likely to go to zero anytime soon. So the risk of the investment just completely failing is very, very, very low. That was one of the things that we were interested in doing because we're hoping that we're going to pay this loan back and continue to get dividends many years into the future. This is a long-term cash flowing asset. That's how we're viewing this. So how has this done since January? Well, the market took a really big hit. The shares went down in price down here in April. Right here, you can see this. The shares went way down in price. We lost like 25%, but the dividends were pretty consistent. So this is the annualized dividend payout. And you can see it's pretty consistent. It goes up and it goes down. But for the most part, it pays out right around 50 or 60 bucks every single week. And that didn't change, even though the value of the shares went down. It's kind of like your rental property. Your actual rental property, the value of it does go up and down, possibly every single day, but it's kind of in relation to other properties selling in the area and then overall appreciation of a particular market. The difference with rental property, you can't just look it up any day and see what the change is and get in and out of it if you wanted to. So we're not treating this any differently than that. We're just going to buy and hold. We're going to ride the ups and the downs. And if it's an investment that pays off, great. If it doesn't, live and learn. Okay, so it kicks off dividends. And it's done that every single week. And the price did come back up. So where we're at right now, the current price, $35.49, it's paid out $2,171 in dividends, which we've used to pay down our loan. So we track the loan over here on this spreadsheet. 5% interest. This is the cost per day for that interest. It's not quite that high actually because I'm calculating this as if the interest were compounding daily, but it doesn't. So I'm being more conservative in this case. But the point being, these are our dividends that are paying back the loan. And where we're at right now is here. The loan balance is $8,180. The current share value, $8,907. So we're up almost $800 right here. And if you account for the dividends, our total with the growth and the dividends would be $11,079, or we're at 111%, or just an 11% return in the last 10 months. Not bad. That's pretty good. I think for the most part, if we only looked at this particular return, you would be pretty happy with that, I think. I'm happy with it. If I needed to sell those shares right now, I could, and I could pay that loan off. But I don't need to. Now, the nice thing about borrowing from my life insurance policy is I don't have to make any minimum payments on it. But I'm demonstrating this because I could have taken these payments each week and made minimum payments if I had to on just your regular type of loan. Now, one of the reasons that I did this, and I did it as a challenge for my channel, was proof of concept. But essentially, from a risk level, it was very, very low. I only have to cover the interest generated on the year, which is $500. 5% interest on 10 grand is $500. I knew I was going to be able to make that in just a couple of months from the dividends, whether this goes up or down. And if I needed to stretch it out longer than 3 years, I can do that if the market were to come down. Ultimately, we expect that the NDX, the underlying asset, is going to continue going up over time and will benefit from that from an overall value standpoint, in addition to getting the dividends. So all things put together, it was a very, very low risk investment option for me to take a loan from my life insurance policy because it doesn't require a payment every single month. I only really need to cover the interest each year if I don't want the loan interest to compound, but I don't even have to make that payment if I don't want to. So very low risk, and ultimately it's been paying off. Now, when we got into this, remember, QDTE was outperforming NDX over the year prior. Well, how has it done this year? One of the downsides to these types of covered call ETFs is sudden movements to the upside, because our upside is capped. If we're in individual tickers like Tesla or Nvidia or Google or Amazon, those stocks can move very quickly in a day or a month. Having a covered call on those is very risky for missing out on the upside. But all of these covered call ETFs funds participate in the downside. So if you cap your upside and you only participate in the downside, you're really limiting your growth potential compared to if you were just to invest in the underlying. But as that prior year had shown against this major index, the major indexes that have a basket of 100 or 500 stocks, those don't tend to move more than 1% in any given day. And if the company that's doing the covered call selling, if they're selling those covered calls at 1% out of the money, it's not very often that they're not going to be able to capture that extra income. So ultimately, as long as there's not a lot of big up days that blow through that strike price and end up costing you money to buy those covered calls back, you should perform similar to the underlying, and you might actually outperform it. Now, we happen to have a very volatile year this year, and it has underperformed. That was the price of the NDX when we got into it. This is the price today. It's had a good year, even despite that big drop. And if I had just been in the NDX, we would be up 118%. Now, you might look at this today and say, well, yeah, clearly that was dumb to get into this type of a fund because this outperforms it. Why not just be in this? Well, I kind of explained the reasoning behind it, the rationale behind it. Originally, it was outperforming, and we had a specific need for income. Also, I didn't want to pay attention to this. This is like set it and forget it. The only thing I have to do is take those dividends and go put them towards the loan. It's a very easy thing to manage. Now, I happen to be a savvy investor. I'm familiar with options, and I could just manage this myself inside of an account. And in fact, you don't even need to know how to do options if you would just use the underlying for something like this. So let's take a look. I made a spreadsheet here, and this is what the NDX would do if I just took that $10,000 and put it into NDX at that same time where I did QDTE. For some people, this could be a better option. And ultimately this year, you would have outperformed what QDTE did. Now, $10,000, you would have to be able to have a brokerage account that allows you to buy partial shares and sell partial shares. Essentially, you're going to use it doing a dollar amount and not buying per share. $10,000 would have bought 0.46 shares, 0.467, not even half of a share. That's $10,000 worth because the NDX is a very, very high valued index. Now, as we could see, the value of it today, 11,800, if we had put in that 10,000 here, and this is the value of the underlying today. This was the value of the underlying when we started. Okay, so that's how this is laid out. What I put in here was, what if we took the same dividend that QDTE was paying out, but in this scenario, we're just invested in the NDX? If you weren't paying attention to QDTE, you might not know what to take out. So let's just say that you were trying to meet a particular loan payback like what we're doing. You might not vary the amount. You might just say, oh, I'll just do $50 every single week rather than try to match it. But I wanted to match it in this scenario because we want to compare where would they be, because the market went down quite a bit and then came back up. Would it have made a difference in this scenario? So these are each payouts that matched the payouts that QDTE made every single week. You can see the value of the underlying went down quite a bit and then climbed back up. And ultimately, we would still have 0.367 shares despite pulling out all of those dividends. And this 0.367 would be worth $11,721. And we took out $2,171. Wait, that's not right. This would be the amount if we still had 0.46 shares. Let me fix this. Now we've got it corrected. So it dropped in value. We're taking money out all along the way. We still took out the same amount of money, but now we only have 0.367 shares. And those shares have a value of 9,322. Over here in QDTE, our shares are currently worth 8,900. So we're like $400 behind. If we add this and this together, that's $11,493 compared to $11,079. So in this scenario, so far, we're not done with this. We're going to keep tracking this. I do regular updates on this once every month or two on this particular challenge. So be sure to subscribe if you want to continue following along with this. But this right now, we're happy with how it's playing out here. But had I actually just done it inside the NDX, we would be in a better position. Pretty interesting to see how this stuff plays out. Now, I have another hypothetical spot here, which is I'm tracking what happened if I just dripped the shares. If I didn't have a loan, if I just had $10,000, I put it in, and every time a dividend kicked out, I automatically just rebought at whatever the share price is. This is what it would look like. I would have 321 shares right now, and the value of those shares, $11,395. I would only be slightly behind actually owning the NDX. Oh, that's interesting, isn't it? That is interesting. Total growth, 114%. Well, if we started with 10,000 and the actual NDX with the payout would have left us at 11,479, it's less than $100 more that's in here. Now, you can't really compare those two because in this one, we took the money out and we went and used it and did something with it. Realistically, you're going to compare the reinvestment of the dividends with actually owning this without making any changes, in which case we would be up 18%. So you would be 4% up. Now, will this hold up over the next few years? Time will tell. My guess is if we're in a very volatile market, that yes, the underlying will continue to outperform it. Okay, so we've covered total return. Let's cover taxes. Taxes are always important, and we need to take that into consideration unless you're choosing one of these options for a different reason. But ultimately, consider the tax consequences. With the reason that we went into QDTE, which was we took a loan and we needed to pay that loan back. So we knew we were going to take money out and we were going to do it every single week. QDTE has specific tax advantages in the first year. We're going to get some return of capital as a classification on a lot of the dividends. That means we're not paying any taxes on that. It's just coming off of our basis. We will pay taxes, short-term gains, so income tax rates, on what's not return of capital. Now, we don't know what the return of capital percentage is going to be, but I expect it to be very high, like 80 or 90% in the first year. It may continue that way for the next couple of years, which means we're not going to be paying taxes on the majority of the dividends or what we pulled out to go pay off that loan. Now, at some point, we're going to have all of our tax bases paid out in dividends, at which point, when the fund manager that's managing QDTE, when they send us the tax forms at the end of the year, return of capital is going to be long-term capital gains for me because I've already used up all my bases, unless I start reinvesting dividends and I have more basis to offset. But let's assume that we don't put any more money into it. We just continue to use that money and invest it somewhere else, which is probably what I'm going to do. I will probably invest it somewhere else. Depends on our cash flow needs. But at some point in the future, the return of capital classification is going to be considered long-term capital gains for me, and the short-term is going to be income tax. So if it continues to end up paying out 80% or 90% return of capital, I'm going to pay short-term capital gains on those. I mean long-term capital gains. That's really good because long-term capital gains can be extremely low. Depending on your income, you could pay 0% on long-term capital gains up to 20%. Now, those rates can change in the future as well. So we're just talking about the rate things are at right now. While short-term income tax rates are a lot higher. How is the NDX taxed? NDX has pretty favorable tax treatment. It's a cash-settled index, and everything gets treated as 60% long-term capital gains, 40% short-term. That's really good treatment if you would otherwise have all short-term capital gains treatment. So it's a very popular index for selling options and making current income, knowing that it's not all going to get taxed at your current income tax rate. You don't get any return of capital. You're not going to ever get 100% of your basis back. There's always going to be a tax consequence on it. When you buy and when you sell, any profits you make are going to be taxed 60-40, long-term and short-term. There are some advantages in this short term for how I'm using QDTE that makes it tax advantageous. If I wanted to enter a long-term position inside of this, rather than getting the NDX, we might consider just using triple Q, because that one does not get the 60-40 tax treatment. And we can end up holding shares. It's not a cash settled index. We can end up holding shares for a long period of time and end up getting long-term capital gains. That's one way to own the ETF. If we weren't going to do that, we can put together a portfolio that matches the NDX and get long-term capital gains treatment if we're not going to utilize an ETF to manage all of this. So there are more complicated ways to do this stuff to be tax advantageous. But just keep in mind, there's different tax treatments, and how you plan on using it will affect what you should actually invest in. Now, if you're just investing in a retirement account, then it doesn't matter. But after-tax brokerage account, consider the tax consequences. All right, taxes are done. Let's look at how do you choose which one and when would you use them. We've kind of gone over this just a bit, but I think when you might use that as opposed to NDX is, like in the situation where I am, if you're trying to meet a loan payback, if we're using somebody else's money to buy the initial shares and we're going to use the dividends to pay that back, there's advantages tax-wise to getting that return of capital up front and then getting the long-term capital gains treatment later on. It could even be a situation where maybe we utilize QDTE to do the loan payback, and then after the loan gets paid back, maybe we look at moving into a different long-term position, because we are going to pay some short-term gains on those dividends, depending on how much gets classified as return of capital in the future. And if we just sell the shares, we'll just get long-term capital gains at that point, and we can reinvest that somewhere else. So that might be a way to utilize QDTE during the short period for better tax treatment. Alternatively, if you're not a very savvy investor and you don't want to have to think about investing and how much to take out each week, like QDTE is kind of set it and forget it. You can just buy it, and when you see the dividends come in, you know you have money to go spend. You can reinvest it, or you can go spend it on other bills. One of the ways that I would consider utilizing some of this, in fact, I'm going to be putting this into place with my daughters. It's not going to be the most efficient, but their tax rate is super low right now. But if they have a monthly expense like gas, I'm going to encourage them to set up, they're going to start saving money, and they're just going to buy some shares of things like QDTE. Now, we're going to actually do a basket of these things, but they're going to utilize the dividends to go buy their gas. So it's a way for me to get them to start putting money into the market, and they're generating something that they can consider as income that they will put towards their actual budget. Tax treatment is not going to be the most effective, certainly not if we don't get good return of capital, but it kind of doesn't matter right now. I want to get them interested in getting active in the stock market and looking at what could be possible. Some of these things, especially when we have an underlying basket of stocks or an index like this that could be around forever and continue appreciating, there's a really good chance for excellent long-term growth and compounding and getting these dividends that will actually supplement their work efforts. So as I explained this to them, they kind of got a little bit excited about it. I'm going to be doing some videos on this when we institute it, but there are other people right now on YouTube that are basically living out of their portfolio. I'm not going to go that far with helping them get this set up, but we're going to start to think about covering particular bills. So maybe it's a cell phone bill, maybe it's a Netflix subscription. If you take $3,500 and buy 100 shares of QDTE right now, that's going to pay out about $80 a month in dividends. And it might do that in perpetuity. It might not. But a Netflix bill right now is only about $30 or less. So one way to think about it for them might be, I'm going to take this money right now and I'm going to buy 100 shares, and that's going to cover Netflix for the rest of my life. $30 goes to pay the Netflix bill, and the rest of it gets reinvested and buys more stock, which will kick out more dividends. Or maybe they use it to pay another bill as well. So maybe they use the $3,500 and now it covers their gas for the week and the Netflix bill for the month. That can work if you have a really efficient vehicle. So there are a number of ways to think about this that gets it into their head. If I invest in a cash flowing asset, I use the cash that flows from that asset to pay the bills. That's the best way to do these things. Rather than take cash that you have and just spend it, you invest in a cash flowing asset and you use the cash flow to pay the bill. When that bill is paid off or you no longer have it as an obligation, you still have the cash flowing asset left over. So that's kind of how I like to look at these. When might I just do the NDX? If I'm a savvy investor, if I would like to take advantage of the 60-40 tax treatment, if I'm comfortable just investing in the stock market and I don't mind seeing things go up and down, we're not just looking at it for pulling out dividends. Now you could, if you wanted to optimize completely for the highest dividend payout, historically, any type of covered call fund is likely going to underperform the underlying. But then you're going to look at, do you do NDX or triple Q? You're going to have to do some research, see which one might work better for what you're trying to do. But I definitely think that there's a use case for using these high yield dividend ETFs. And there's absolutely a case to say, skip those, just invest in the underlying. But for a lot of people, the simplicity of just getting that dividend is very attractive. And I know for me, even though I do like to optimize, like I'm always trying to maximize my cash flow, there's the simplicity of owning those that I know, even if it's going down in value, it's going to continue to kick off dividends. And at some point, I can just take that cash and buy the dip. I don't have to think about selling high and buying low. And there's something in there for me that allows me to be a better long-term investor, because otherwise I have a challenge, because I watch the stock market every single day and we look at the charts. And if the chart's indicating like there's a likely drop coming, I'm probably getting out of a position. Like that's just the way I'm wired at this point. So I tend to just trade options instead, but I do need to establish some long-term positions somewhere. And also I view these as, otherwise adding to my real estate portfolio. So there's a good case for me, and I will continue to share my high yield dividend portfolio as long as you viewers are interested in it. And if there's anything else that you're looking for that you would like me to cover, let me know in the comment section. We'll be back soon. I appreciate you joining us. See you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.